you'll ever see that, because I think big tech, you have to remember, is basically the index. And in the last 10 or 20 years, you've never seen drawdowns more than 15 to 25%.
Chammath Palhipitiya, a billionaire investor, believes that effective investing is all about behavior and psychology, and that the strongest model or analysis in the world will be useless if investors panic during a downturn. In an interview with a financial website, he states, "The most essential thing you can do to improve your chances of success is figure out what, if any, behavioral advantages you have and can create for yourself." Hey guys, welcome back to Chammath Palhipitiya Zone. Before we move on to the video, don't forget to drop a like on this video and subscribe to the channel if you haven't already. Make sure that the post notifications are turned on so that you never miss a video from us. Without further ado, let's dive in. Palhipitiya, a Sri Lankan-born Canadian-American billionaire, created the social capital venture capital firm in California in 2011. Palhipitiya has established a successful career in finance for the past 2 decades, despite having a degree in electrical engineering. Over the last 4 years, his stock picks and investments as CEO of Social Capital have outperformed the S&P 500 by more than 1.3 percentage points. His firm invests in a wide range of industries including healthcare, financial services, education, consumer products, frontier, and enterprise. Palhipitiya founded the Social Capital Sophia Holdings Corp. V, a special purpose acquisition company, or an SPAC, in 2020, and it has since facilitated mergers, stock exchanges, asset acquisitions, and initial public offerings or IPOs for a number of companies. To figure out if you're about to enter a market crash, pay attention to the warning indications that the market virtually screams at enthusiastic investors who often don't listen. The excitement of large gains, in reality, frequently drives investors down the wrong path, resulting in market disasters. But specifically, what are those red flags? Is it true that they are predicting a crash? The Federal Reserve Bank of the United States, usually known as the Fed, is the country's central bank, which means it is in charge of the country's monetary policy. The Fed has a significant influence in market activity since the stock market is, at its heart, a mechanism that allows for the movement and balance of cash and value. When the Fed concludes the US economy is in difficulty, it implements one of 2 essential policy measures, or a mixture of both. The Fed funds rate is the rate at which banks charge each other for lending excess cash overnight. When this rate falls, interest rates on loans such as mortgages, auto loans, credit cards, and other type of loans fall as well, resulting in a flood of lending. Of course, when the individuals can borrow more money for a lower cost, they do so, resulting in a flood of liquidity in the US economy. As a result, consumers spend more, resulting in larger corporate sales and profits, and eventually a bull market. Lower rates for an extended period of time, on the other hand, can be dangerous indicators because they can't endure forever. Debt will have a slow and interest rates will have to rise at some point, resulting in a tightening of consumer spending, and if the contraction is significant, a stock market crash. The market is supposed to be a well-balanced system, but in reality it is far from that. The stock market battles to keep valuations in check from day to day, month to month, and even year to year as bears and bulls dispute their positions. When the bulls have too much control for too long, the prices investors pay to own shares skyrocket, resulting in severe overvaluation. On the other hand, too much bearish control causes stock prices to fall, resulting in extreme undervaluation. In fact, active traders make it their life's work to profit from the market's erratic equilibrium. Take a look at how long the market has been trending upward. According to Forbes, the typical bull market lasts around 2 years and 7 months. An extended run of the bulls could be a hint that we're due for a reversal. Palhipitiya says people should invest for the long term, as that is the key to successful investing in stocks. Whether it's been my job, my life, or my investing, I've learned that long-termism is an important key to success. I've gotten the most back when I invested my time, vulnerability, and money with a very few short-term expectations, but many long-term ones. Inflation is unavoidable. A moderate and steady increase in pricing for consumer products, services, and any other category is usual as the economy grows. It's why your great-grandparents could buy a whole lunch for a penny, whereas today, a stick of bubblegum costs that much. When inflation occurs too quickly, it creates a concern. The Federal Reserve of the United States has set a target of 2% inflation, which it believes is a reasonable rate of price increases. A high cyclically adjusted price to earnings or CAPE ratio although still on the subject of profitability is another clear warning indicator that a market crash could be on the horizon. The price-to-earnings ratio, which evaluates a company's profitability in relation to its share price, is a 10-year moving average of the classic price-to-earning ratio. The statistic was created by Robert Shiller in 1996 and has been used by stock market analysts and economists for over 2 decades. The CAPE ratio, also known as the Shiller PE, averages price-to-earnings ratio over the previous 10 years, substantially removing short-term peaks and valleys as well as volatility to determine if the market is actually overvalued or undervalued.
In 2018, here's exactly what happened. The setup was the Fed, everybody was worried about what the Fed was going to do on interest rates. The Fed was looking at China as the canary in the coal mine, the leading indicator of what we should do. And at the end of 2018, Jerome Powell decided to raise rates. And we raised rates. And then enter 2019, and the Chinese economy turned over.
Profit is one of the most important factors in the stock market, and for good reason. No one wants to invest in a firm that is losing money and shows no signs of turning a profit. Investors are thrilled when earnings are increasing and are eager to put more money into the stock. The price-to-earnings or PE ratio, also known as the price-to-profit ratio, is a crucial measure used by value investors to determine whether a stock is undervalued or overvalued. In other words, a company's profit aids in determining the stock's fair value. When earnings begin to flatten, it's a sure warning that a market crash is on the way. Investors are only satisfied when the companies in which they invest are profitable. Palhipitiya claims to follow a philosophy of investing in the industry's winner, since success will always follow. If you try to outsmart the market, chances are you won't win. I personally have tried this several times without much success. Remember, the average buyer makes the simple decision to invest in the category winner. There are reasons why a certain company is the best in its industry, and there is a reason why everyone is investing in the company, he says. He emphasizes that investors must prioritize their demands, setting up a solid list of needs and addressing them effectively, and that is critical so that they can get the most out of them for a better future. There are some things that will remain constant regardless of the circumstances. According to the senior investor, investors must maintain their focus in order to keep their preparation for the good times intact and avoid being derailed by discouragements and disappointments. All veteran investors agree that doing adequate research before investing in a stock is critical. Investors, according to Palhipitiya, will have to look at the company's performance before deciding whether or not to invest in it. Fearful investors wonder when the bears will take over and the market will crash, whenever there is a bull market. As prices reach new highs, many people are wondering when the next crash would occur.
And so what's interesting to me is now we're finally starting the process of these hikes. And the real question is going to be, how data dependent do these guys get? Because if we overcorrect,
Yes.
and the leading indicators all around the world tell us that their economies are weak, then inflation may have actually been much more transitory than we thought.
With that, we've come to the end of this video, and if you found it interesting, make sure to hit that like button and let us know your thoughts in the comments section. Also, make sure to subscribe if you haven't already. Stay tuned for more videos coming up.